Chapter 1, Accounting and Business. Accounting is an information and measurement system that has the purposes of identifying, recording, and communicating relevant, reliable, and information that is able to be compared to itself about an organization's business activities. Identifying business activities requires that we look at and select several relevant transactions and events recording business activities requires that we keep a chronological log of transactions and events, so a record based on time of transactions and events that's measured in dollars. Now, communicating business activities includes taking that information and preparing accounting reports, the most common type of such report called a financial statement, which we would then analyze and interpret and use to gain some type of insight about a business or a business's activities. Now, as I mentioned in class, and you'll hear throughout your business careers and throughout school, accounting is called the language of business. The main reason is because all organizations set up accounting information systems to communicate data to help people make better decisions. Accounting can serve many different types of users who are interested in information about a business. Generally, these types of users are divided into two big groups: external users and internal users. External users of accounting information are not directly involved in the day-to-day operations of running the organization. These types of users include shareholders, also known as investors, lenders, directors, customers, suppliers, regulators, lawyers, brokers, even members of the press, journalists. Basically, anyone who is not part of the day-to-day operations of the organization, but has interest in knowing what's going on with the business. Now, internal users of accounting information, as you might guess, are those people who are directly involved in the day-to-day operating and managing of the organization. These would include chief executive officer, chief financial officer, other managerial level employees, executives, all these people that use information that they gain from the accounting statements and accounting information systems, and they take that information and use it to try to improve the efficiency and effectiveness of the organization. Accounting information is in pretty much all aspects of our lives. We earn money, we pay taxes, we invest, we save money, we budget earnings, we plan for the future. All of this is a type of accounting. The majority of opportunities for work anyway are in private accounting, which are employees working for businesses. Public accounting offers the next largest number of opportunities, and this involves doing services like auditing and providing tax advice. Then there are still other opportunities that are available to people who study accounting that exist in government roles, not-for-profit agencies. This could be, on the government side, you could have any type of business regulations. You could have fraud examiners looking and investigating legal violations. And then you could have basically the governmental equivalent of those people who are working in private organizations, who are basically your CFOs and those types of accountants as well. In general, accounting specialists are highly regarded. Their professional standing often is denoted by having some type of certificate. The most common and the type that you probably heard of would be certified public accountants or CPAs. Now for this need to know, what you should do is identify the following users of accounting information as either internal or external users, remembering that external users are not directly involved in running the organization, whereas internal users are directly involved in the day-to-day operations. Regulators are not directly involved, they're external users. The CEO obviously is very involved, so that's an internal user. Shareholders not directly involved in the day-to-day operations, so they're external. Controllers should be very involved in the management of an organization, as that's someone in the higher ups of the financial side of the organization, so that's an internal user. An executive employee is generally directly involved. That would be another internal user. External auditor is not actually running the organization, so external auditors are external users because they're not within the day-to-day operations. Production manager, obviously day-to-day operation, internal user. Non-executive employee, even though they have a stake in the organization, since they're not directly involved in running the organization, generally non-executive employees or non-management employees are considered external users. And the main reason for that is because the information that they would be looking at about the company, they would not be using that information to run the company. And that's why we distinguish between an internal and external user. If a non-management employee is looking at financial information of a company, it's not because they're interested in using that information to make decisions about how the company is going to operate. And it would generally just be either out of curiosity, or maybe the employees have, maybe all employees have some type of investing opportunity in the company and they want to know how things are going, but not considered an internal user. The main goal of accounting is to provide useful information for making decisions. If you're trying to provide useful information for making decision, that information obviously needs to be trusted or trustworthy. That means that there has to be very strict ethical guidelines or ethics within the field. Generally, ethics are considered accepted standards of good behavior and what's considered bad behavior. The first step in facing an ethical concern is obviously to recognize that it is an issue. Then, in any case, but specifically with regard to accounting, you need to analyze options, recognizing that there will be good and bad options, and then finally choosing the best option, weighing all the consequences. The fraud triangle is a model. In this case, when we talk about a model, we're basically talking about this little triangle pictograph that they have here. It's created by a criminologist that asserts that the following three factors must exist for a person to commit fraud: opportunity, pressure, and rationalization. And we won't talk about the fraud triangle all that much in this class, but if you move on to either a more specific managerial accounting class or auditing, you'll likely see the fraud triangle a lot more and spend a lot more time on it. So financial accounting is governed by concepts and rules that are known generally by the acronym GAAP. And GAAP stands for Generally Accepted Accounting Principles. GAAP aims to make information relevant, reliable, and comparable. Relevant information affects decisions of users. So if it's irrelevant, then it's not going to change the way someone decides to do something. Reliable information means that it can be trusted, and comparable information means that you're able to compare kind of in an apples to apples way, where you're looking at the same type of information from either two different organizations or two different time periods within the same organization. In today's economy, things are more and more global. So there's increased demand by external users to have comparability, or again, like I was talking about, the apples to apples comparison in accounting reports across the world, basically. So obviously, when companies want to raise money from lenders and investors in different countries, it's helpful for all parties involved to be able to look at the same financial information and understand it the same way. Because of that, there's this entity called the International Accounting Standards Board, and this standards board is basically developing these, again, they go by an acronym called IFRS, and this stands for International Financial Reporting Standards, and these are basically accounting guidelines that more and more countries are adopting as their standard, that allows every country who's using them to have the same type of accounting guidelines so that accounting information can be comparable country to country. The FASB, or the Financial Accounting Standards Board, and the IASB, or International Accounting Standards Board, are currently in the process of attempting to converge, or have both of these standards come together, where they're basically the same type of standards, so that the United States can also be a country that uses these international standards. And I guess the end desire is to have the United States be producing these comparable financial statements as all the other countries that are using this framework. Accounting principles and assumptions are of two types. You have general principles, and general principles are the basic assumptions, concepts, and guidelines for preparing financial statements. And then you have specific principles, and these are detailed rules used in reporting business transactions and events. General principles stem from long-used accounting practices, whereas specific principles arise more often from rulings of some authoritative group. The measurement principle, which is also called the cost principle, usually means that accounting information is based on actual cost, with the potential for some subsequent adjustments based on what the market price is doing today or more recently. Cost is usually measured on a cash or equal to cash basis, which means that if cash is given for a service, its cost is measured as the amount of cash paid. There are three concepts that are important to the revenue recognition principle. Revenue is recognized when earned. The earnings process is normally complete when services are performed or a seller transfers ownership of products to the buyer. Proceeds from selling products and services need not be in cash. A common non-cash proceed received by a seller is a customer's promise to pay at a future date, which is called a credit sale. So basically, you don't have to receive cash to have received something. You could just be getting essentially an IOU, and the fact that you've received that IOU and the transaction has taken place means that revenue has actually been earned. And we'll cover that a lot more in depth as we move through the semester. Revenue is measured by the cash received plus the cash value of any other items received. The expense recognition principle, which is also called the matching principle, says that a company should record the expenses it incurred to generate the revenue reported. Basically, the idea is the timing of recognizing an expense that you have incurred should coincide with whatever revenue that expense helped to earn the company. The principles of matching and revenue recognition are key to modern accounting. The full disclosure principle states that a company is required to report the details behind the financial statements if the details, when they are disclosed in that manner, would impact users' decision-making processes. So most of these details are reported in the notes to the financial statements. And what that basically means is anything that would be relevant information to a user of financial statements that isn't in the required financial statements themselves, but that a company knows about or should know about, has to be disclosed in these notes to financial statements. Now we need to look at 4 fundamental assumptions of accounting. The going concern assumption states that in the absence of information to the contrary, the business entity is assumed to be continuing operations into the foreseeable future. So unless you know for sure or have a good idea that a company is going out of business, we are assuming that it will go on forever. The monetary unit assumption tells us that we will only record accounting information that can be expressed in monetary units. In the United States, obviously, that would be in United States dollars. The business entity assumption tells us that we must separate out the transaction of individual owners of a business from those of the business itself. So just because I own part of a business doesn't mean we're going to include all of my personal transactions with the transactions of the business. Finally, the time period assumption presumes that the life of a company can be divided into time periods such as months and years, and that useful reports can be prepared for those periods. So if you look at most financial statements, they are divided either into quarters or years. And those would be the time periods that kind of serve as benchmarks to compare amongst other companies and to compare one company to itself. A sole proprietorship, or simply a proprietorship, is a business owned by one person. The business is a separate entity for accounting purposes. However, the business is not a separate legal entity from its owner. A partnership is a business owned by 2 or more people called partners, which are jointly liable for tax and other obligations of the business. Like a proprietorship, there's no special legal requirements that have to be jumped through in order to start a partnership. So basically, if you start working as more than one person working together to bring about some type of commercial enterprise, you have formed a partnership. Now, a corporation, the most common type of which is also called a C corporation, is a business that is legally separate from its owners or owner, meaning that it's responsible for its own acts and debts, and that theoretically the owners of the business cannot be asked to pay or held liable for the actions of the corporation itself. Congress passed what's called the Sarbanes-Oxley Act, or SOX, as it's commonly referred, to help curb financial abuses at companies that issue their stock to the public. So these are the companies that trade on the public stock exchanges, probably most notably the New York Stock Exchange, or NASDAQ, would be the 2 most popular in the United States. And SOX basically requires that these public companies apply both accounting oversight and much more stringent internal controls, with the desired outcome being more transparency and accountability and trustworthiness of these financial statements that are issued. I'm not going to spend too much on the Dodd-Frank Wall Street Reform and Consumer Protection Act. Spend too much on that slide. You guys can go over these need-to-know slides on your own if you'd like. We'll cover, obviously, when we work in class on some of the questions that we'll work through, we'll cover some of this as well. Okay, so we talked about this a little bit in class on this past Wednesday. This is the basic accounting equation. The accounting system reflects two basic aspects of a company, what it owns and what it owes. Assets are resources a company owns or controls. Some examples of this would be cash, supplies, equipment, land. Each one of these carries some type of expected benefit. The claims on a company's assets, what it owes, are separated into owner and non-owner claims. That's why you see the categories of liabilities and equity. Liabilities are what a company owes to someone who's not one of its owners, whereas equity is what a company would owe to its owners, or what type of claim the owners have on the company. Again, like I said before, you can look over these need-to-know questions and kind of quiz yourself as you see fit, knowing that, of course, we will cover this stuff together in class a little bit as well. So this section introduces us to how financial statements are prepared from analyzing business transactions. The four basic and main financial statements that we'll talk about in this class are an income statement, which describes a company's revenues and expenses, along with the resulting net income or loss over a certain period of time. Statements of changes of owner's equity explains changes in equity from net income or loss, and from any owner investments and withdrawals, generally over the same period of time that we're talking about the income statement. A balance sheet is often described as something that describes a company's financial position at a specific point in time. So as of this certain day and time of day, so let's say as of December 31st, 2016, this is the exact number of assets and liabilities and claims on owner's equity that a company has. So that's what a balance sheet looks like. And you'll notice also that a balance sheet is basically the official documentation of the basic accounting equation. It shows you assets, it shows you liabilities, and it shows you owner's equity. And finally, we have statement of cash flows, which, as the name implies, identifies cash that comes in and cash that goes out over a period of time. This is just showing how through the account statements, totals from one account statement flow through to another financial statement, and so that these are all generally prepared around the same time, and you will use components of one to flow into another. So accounting according to US GAAP is similar but not totally identical to IFRS, or the international standards. Both US GAAP and IFRS include broad and similar guidance for accounting. Neither US GAAP nor IFRS specifies particular account names nor the detail required, although IFRS does require certain minimum line items be reported in the balance sheet along with other minimum disclosures that currently US GAAP does not require. And there's lots of little differences like that. I'm not going to spend too much time on the differences right now between US GAAP and IFRS. If you are an accounting major and you end up studying for the CPA, first of all, some of the changes that are different right now will have converged and not be different by the time you go to sit for the CPA. And eventually, I think that it will be totally converged and there won't be any differences. So I don't spend too much time on that. You can kind of cross that bridge when you come to it. This is just an overall map on who has adopted IFRS so far. And as you see, the United States is one of the more notable developed countries that has not completely adopted IFRS. But we are in the process, so I'm sure that will continue to change as time passes. So we'll look at some of these ratios, as you see here, return on assets being the first one we look at throughout this course. And basically, these ratios that we look at are tools that generally both external and internal users of financial statements develop certain ratios that are kind of a snapshot of a certain type of information that helps you to understand maybe how a company is performing with respect to this particular aspect. So investors use these ratios a lot to kind of almost serve as like a scoreboard for how a company is doing compared to another company. Well, what are the return on assets of Google versus Yahoo or some other two companies that we're trying to compare. So throughout the semester and throughout this course and Principles 2, you'll see that we look at all sorts of different types of ratios that help us to understand something. So return on assets is a type of profitability measure. It's generally useful in evaluating management, analyzing and forecasting profits, and planning activities. Generally, as far as testing goes, I won't cover too much that shows up in the appendices of the chapters. So this is Appendix 1A, and you can take a look at the stuff that's in the appendices at the end of the chapters. Sometimes it's interesting stuff. If it pertains to you, for instance, if you're a finance person or going into finance as your major, may be interesting to take a look at some of this stuff. If you're not, just know that it's there, and if something comes up that interests you, take a look at it, but you don't necessarily have to learn it for the class.